Hello and welcome to our Business Management Unit 7. We've been talking about business finance in this unit. So in this lesson, we're going to be talking about individual investing. So the objectives are to discuss the pros and cons of different investment types and the risks that may be associated with each, and to analyze the asset classes and create diverse portfolios based on various example investments. So we're talking about individual investments, such as stocks, bonds, mutual funds, exchange-traded funds or ETFs, real estate, REITs, certificates of deposit, savings accounts, cryptocurrencies, commodities, and Forex. Now, some of these I discussed in lesson 7.7. So you can go back and look at some of the details on these. Just as businesses can invest in some of these, individuals can invest in these as well. But in this lesson, I'm going to simply, since I talked about some of these things in lesson 7.7, this time in this lesson, I'm going to discuss investments not previously mentioned, and that's these four here. So mutual funds. These are funds where investors pool money to invest in a diversified portfolio of stocks, bonds, or other securities. It's a collection of stocks in large, medium, and small companies with various amounts of risk and earnings. It's usually managed by a fund manager who buys and sells individual stocks. Exchange-traded funds, or ETFs, are similar to mutual funds, but they are traded on stock exchanges like individual stocks. They contain many types of stocks, kind of like a basket of different types, and they are traded all throughout the day, while mutual funds trade only after the close of the business day. This is a medium risk, medium to high return. Certificates of deposits are deposits with banks or credit unions that earn interest after the maturity date. Typically, they're lower risk, but you also have lower earnings. They often have short-term maturity dates, usually between 3 months to 5 years, not longer than that. Savings accounts are deposits with banks or credit unions that pay interest on the funds. Usually, they're very low risk, but also very low earnings. Now, investment risk. Investment strategies vary based on personal risk tolerance and risk management. Now, risk tolerance is how much risk you're willing to tolerate or handle. How much money are you willing to put into the investment? And risk management is the process of identifying and assessing those investment risks. So there are high-risk investors who seek high potential returns, and they accept greater market volatility. Now, volatility is the variations, the price fluctuations over time. They may experience significant gains or losses. On the other hand, conservative investors choose lower risk investments, accept more modest returns, lower returns, and they experience less market fluctuation. Asset allocation is a key risk management tool because in this case, you're distributing across different investment types. There are three main asset classes. There's stocks, which are higher risk, bonds, a medium risk, and cash is the lowest risk. Now, the risk levels vary by allocation, where you're putting the money. More stocks equals higher risk, but also higher potential return. More cash equals a lower risk and lower potential return. It's important when you're individually investing to match your allocation with your own personal goals. So you got to look at diversification strategies. Now, diversification is spreading your investments within an asset class. And diversification helps manage that risk within those asset classes. So some ways to diversify is to put your money in different company sizes, small, medium, large cap. Visit various industry sectors, maybe putting it in agriculture as well as manufacturing. There's different types. You can use different type of mutual funds. You can look at different geographic regions. Overall, kind of the thing about diversification is to remember this phrase: don't put all your eggs in one basket. Now, market conditions and timing. There are essentially two market cycles. This is the bull market, where there's rising market values and is generally good for buying growth stocks. But there's also the bear market. This is when market values are declining, and this is an opportunity for value investing. You also have to consider timing, when to buy, what to sell, and when to hold on to your investment without buying or selling. So that is our lesson 7.9 on personal investing. The objectives were to discuss the pros and cons of each different investment types and the risks that may be associated with each, and to analyze asset classes and create diverse portfolios based on various example investments.